Hey guys, Jared Wesley here of Live Traders. I hope you guys are doing well today. It's Wednesday, which means it's lecture time. So I have another great lecture for you guys today. Today is on money management as well as spreads. I do talk a little bit about order entry as well in terms of market orders versus stop limit orders. It's a little bit of a longer lesson. It's almost an hour, about 55 minutes, I believe. And I also threw in a little bit of today's trading montage. It wasn't a great day. Honestly, it should have been an unbelievable day. I took AERI for just over 400 bucks. Probably should have made 700 on it, but it is what it is. So I threw that in. That's only 1 or 2 minutes, but stick around because right after that little mini trading montage is the lecture on money management as well as spreads. You don't want to miss this. And why don't you want to miss it? Guys, most of you guys out there are blowing up your trading accounts because honestly, you're stupid. You're just doing dumb things. You have to understand this is not a FOMO business. This is not a fear of missing out type business. The market's going to be here tomorrow, next week, next month, next year. That trade you're looking at right now, no, it's not the be all end all greatest trade you've ever seen in your entire life, okay? There are plenty of other great trades. So if you miss it, you move on. But the number one job as a trader is to protect your trading account first. Making money actually comes second. Protect your ankles, man. Protect your backside first. Then think about making money. So this video talks a lot about the mistakes that traders are making out there. Taking stocks that are super spready, not using stop losses, using market orders to get into trades, getting filled $1 late on trades. Just crazy, silly stuff, guys. All right, so let's head over to the computer, check out the 1 or 2 minute trading montage on AERI, as well as today's lecture on money management and spreads. All right, guys, AERI, I like it over 48, guys, 48 by 47.50, all right? I just nibbled some. I'm going to add a little bit here, guys. AERI, 48 by 47.50, okay, guys? It's a little thin. It's very thin. The volume's going to come in later. I just got a few more shares of this thing. I'm a little concerned that the spread is going to open up, but right now, so far, it's okay. It's got about a nickel spread. Well, I think once it breaks 48, there we go. Okay. All right, there we go, guys. Look, see the spread? What did I say about the spread? All right, guys, 26-cent spread right there. You know, it is what it is at this point, guys. We're share sized properly. If you need to take a little bit off because the spread is so big, I'm probably gonna take just a little bit off because the spread is so big. But I think this thing can really get back to 49, 50, something like that. So keep an eye on the AERI, guys, okay? All right, guys. The spread's tightening a little. This thing's about to rip, I think, guys. I think we're about to see a nice pop. Look at how there's the spread again. It's okay, guys. I'm going to peel a little bit more off here. Okay, right here, guys. Peel some off 48.70 area. I'm going to try to get like 600 out of this thing. I've nickeled and dimed it just a little bit, but there we go. There we go. All right, there we go. Try to peel a little bit off, a little more here. I didn't get it, guys. It's coming back in a little bit. It's all right. I think it's going to come back up, but look at that spread, guys. 30-cent spread. I really don't like to be in trades with 50-cent stop losses that have 25-cent spreads. Maybe that's something I'll talk about later in today's lecture a little bit. But anyway, guys, not a bad play so far. Making money. Stops at break even, guys. Stop is at break even. All right, one more time. Stop is at break even. Let's shoot for like 49.20 on the last lot of this. All right, guys, I'm going to be peeling some more off here on a pop over 49 bucks. I wish I would have held just a little bit more of this, but I'm going to be taking some off on a pop over 49. All right, guys? Look to take some more off here. There it is, guys. All right, I just drug the order down a little bit. I only have 50 shares left. I'm going to be a little bit off on this one. Like I said, I was looking for 500 or 600. It looks like we're going to end up with about maybe 500 on this. We'll have to wait and see if it comes back down and tags us at break even. But stops break even. We made about 400 so far.
on ACB.
Well, that ended up being a good exit on AERI. It did end up going $1.30, which was 2R. So I only got $400 out of it. I should have done better on that risk. You know, we're looking at about a 350 risk. So I didn't do nearly as well as I should have done on this, but that's the way it goes. All right, guys. So this week's lecture is on money management and spreads. And you're thinking to yourself, well, that's an odd topic in terms of why those two things, money management and spreads. What's been happening lately, and I've been seeing this through comments on social media and comments in the chat room and people emailing me, I'm really disappointed, discouraged, or even a little bit, I guess, upset about what some traders are doing out there. And you have to understand, guys, I say this frequently, but it's not sinking in. Money management is your number one job, period, end of discussion. Okay, it's more important than making money is protecting your account first. Okay, there's too many gamblers in the trading industry, and there's too many thrill seekers in the trading industry. And that's not what this business is about. This business is a systematic way to make money. You don't go into any other job in the world and tell your boss, hey, I need $1 million. No, you work there for your 100 grand or 2 or 3 or 400 grand a year, and you slowly build that. Trading is no different. So I want to talk about money management, account management today. See, a lot of people get turned off by this topic because they think, well, that's not very sexy. This is not a sexy topic. It's not. But it's the single most important topic there is in trading. And I'm combining this topic with spreads because it has a lot to do with money management and a lot to do with a lot of recent comments I've seen and a lot of recent emails I've gotten. So I put in some recent charts, okay? I put in a lot of charts with spreads, and there's also going to be a lot of charts with text, okay? Because you need to see both. It's a topic that, like I was saying before, I don't mess around on this topic. This is not a fun, ha-ha, joking topic. You know what I mean? This business, the problem is there's just so much crap out there on Google, on the internet, and social media, and everybody's trying to tell you that they're getting rich overnight and that they took this, let me teach you the one pattern that changed my life. And I have titles that say that too, you know, on some of my videos as well. But then once you actually listen to it, you realize it's real stuff. I'm not sitting here telling you, oh my gosh, I just took $500 and turned it into $100,000 in 30 days. It's garbage, guys. If that's your idea of trading, then you might as well just take your trading to Vegas. You'd be better off buying chips at a blackjack table, okay? Because this isn't your business. All right, this is a slow progression. It's a systematic way to make money, right? So let's talk about this first, guys. I'm going to combine them. So I'm going to go back and forth, and I'm going to flip-flop slides as I go through this because there's some topics that that cross over, so to speak. You know, we talk about technical charts. Technical charts sell, guys. They really do. You know what sells? P&Ls and charts. Everybody wants to see charts, 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 charts. And then once you show them a great chart, what's the next question? How did you find it? Where did you find it? So what topics out there sell? Charts and scanning, right? If you can tell somebody, oh, I'm going to show you how to scan for this perfect pattern. Well, the perfect pattern is a chart, and scanning is chart-based. And I'm not saying those topics are not important. Of course they're important. But they're a lot less important than managing your account. And what I'm seeing traders do out there is just downright suicidal. Like suicidal. Like I'm blown away by what some of you guys are doing out there. And we had a long discussion yesterday about not taking stop losses or taking trades without an intended stop. So I'll discuss some of that as well today. But if you can't manage your account, if you can't keep losing trades and losing days under control, you'll never make money. Right? You're going to ride the roller coaster, and you're going to have that like flower petal, she loves me not. One day you make money, you feel high as a kite, and the next day you lose money and you want to walk off a bridge. That's not trading. Okay? Trading is a boring, non-sexy business. But on social media, and I'm guilty of it too, we make it look like it's exciting and sexy. If you're in it for the excitement, it's not for you. It's not about excitement. All right? So here, guys, at Live Traders, there's two things: objectivity and common sense. Use objectivity and common sense. And I'm going to come back to those two comments, okay? So be objective and use common sense. We all know what common sense is. We just don't always heed to it or abide by it, right? We all know what common sense is. Like, for example, having a 20-cent stop loss on a stock that has a 50-cent spread. That's the example of not using common sense. And you knew damn well that was stupid, but you did it anyway, right? Why? Because it wasn't going to pull back. It was just going to hit and run, right? Because, you have 100% batting average, right? You've never lost a trade, right? You get my point? It's just stupidity. So respect and protect your account, guys. Trade small until you're consistent. And this one down here doesn't get enough play, all right? You earn the right to raise risk, guys. You don't raise risk because of time put in. I don't care if you've been trading 8 years, 10 years, 12 years. If you don't make money, if you're not profitable, you don't raise your risk. I don't care if your mortgage is due. So what? Does the market care? No. If your mortgage is due, find another way to pay your bills. Go get a side hustle. Sell stuff on Amazon, eBay. I don't care. But if you're not good enough to make money in trading, you don't just automatically take $500, $1,000, $2,000 risk on a trade just because you think you deserve it. You know how you know when you deserve it? Your stats, your statistics. When you go back and look at your tracking spreadsheet, because I know every one of you out there is tracking your trades, wink, wink, right? Everybody tracks their trades, okay? Your tracking spreadsheet will tell you exactly if you're ready to raise your risk or not, okay? Most people are not, but they raise it anyway. Why? Because they feel like they deserve it. Do you know what I mean? And that's like somebody who's broke, who's depressed, and they go shopping and they don't have any money. Why? They need it to feel good. They feel like, I deserve this. I've worked hard. No. If you're broke and you're depressed, find something else that doesn't cost money. Same in trading, guys. You earn the right to raise your risk. I know people get tired of hearing me say that phrase. You earn the right to raise your risk. But that's what this business is about. And I always use the word business. Okay? This is not some passing thing. If it is to you, then move on. Pass along and go to something else. Okay? New traders, I'm not going to spend as much time on this, guys. Notice you see that you earn the right to raise risk again on the next slide right after you just saw it. You have no business risking more than $10 to $50 per trade if you're new. $10, $20, $30 risk. I don't care what any of you out there think about what I'm saying. I don't care. I know I'm right on this, and I'm not even willing to budge a millimeter. I don't care if Jeff Bezos came in and said, well, geez, Jared, I got $100+ billion. I'm going to risk $1,000 a trade. Why? That would be dumb. And you're going, well, he can afford it. He can afford to lose money stupidly. Think about that statement. He can afford to knowingly lose money. That's the dumbest thing I've ever heard in my life. Rich people aren't rich because they unnecessarily lose money. Okay? Now, most people are poor because they do stupid things. You see where I'm going with this? People that have money because they're smart with money. People that don't have money because they're dumb with money. Risking more than $10, $20, $30 a trade when you're a new trader falls into the I'm dumb category. I'm stupid. Okay? I don't care what you think about how I'm saying it. I don't care if you think it's over the top. I don't care if you think it's too strong. I don't care what's in your account, and I don't care what your life is. If you're new and you haven't made any money in this business and you're an up and down trader and you're struggling, it's $10 to $30 a trade. Don't care what anybody else on the internet thinks about it or says about it. I'm right. I'm 100% right. You don't lose money because of your ego. That would be the only reason you would risk more than $10 to $30 a trade. Because of your ego. Period. All right? Yes, I'm spending a long time on this. Okay? Because it's that important. All right? It doesn't matter. Okay, guys, I'm making this comment because somebody's making a comment to me. It doesn't matter how much money you have. Okay? Let me ask you guys a question. Just because Jeff Bezos has $100 billion or whatever he has these days, do you think that he would walk into a store and pay $50 for a Snickers bar? Probably not. I'm not saying he can't afford it. Nobody's saying that. But you look at it and go, well, that's just exorbitant. $50 for a Snickers bar. Well, you wouldn't do it. You just go to the next convenience store and buy it for $1 like everybody else does. It's not about how much money you have. It's about how much you're going to lose. I didn't say probably lose, might lose, maybe lose. Definitely going to lose when you're a new trader. You're going to lose when you're a new trader. So would you rather lose more or lose less? Let me ask you guys another question, all right? I use this analogy frequently, so if you've heard it before, I apologize. If you've never played golf before in your entire life, ever, just like you've never traded before, would you go play Tiger Woods for $1,000 a hole? I don't care if you're Bill Gates. Why would you do that? He's just going to take 18 grand from you. Why don't you just give him the $18,000? Now, we're not talking about lessons you can learn from Tiger. That's not the point. The point is just hand over your money to him. If you're a new trader, you trade $10, $20, $30 risk per trade. I don't care if it, quote, if it doesn't feel like real money. Well, if it doesn't feel like real money, then you should make a ton of money then, shouldn't you? Because nobody loses in the simulator. I hate that excuse. I get it all the time. Well, if I only risk $20 a trade, it just doesn't feel real. Well, then I always tell them my retort is the same. Well, then you should make a ton of money because nobody loses in a simulator. And if it doesn't feel real, then it'll just be like simulator trading. So why don't you do it for a month and show me how much money you make and then get back to me and we'll talk about it. Nobody's ever gotten back to me yet. Doing anything other than the suggestion above is akin to throwing away money, period. I should highlight that and underline it. All right? Let results be your guide. Let your results determine whether or not you should raise your risk. One of the single biggest mistakes, guys, is new traders, they risk too much too soon. Their experience, right, is just, it's not good enough, right? Their risk exceeds their experience level, okay? And that's it. Plain and simple. Their risk exceeds their experience level. So I know I spent a long time on this slide, but I don't care. It's that important. Okay, now basic stuff I'm not going to spend a long time on, guys. I'm putting this up here because I've had a few things happen recently in the last few days that are just mind-boggling to me. So let's just go through this briefly. And for some of you out there, R means risk level, okay? So let's go through this, guys, okay? Risk level is simply the amount of money you're willing to lose, not make. Lose on a given trade if you're wrong. Let me tell you something. I don't care what Google says. I don't care because I had somebody come into my chat room last week. I've won 500 consecutive trades. And I said, so do you want to meet on my yacht or yours? Crickets, 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 crickets. If you've won 500 consecutive trades, then why aren't you sitting next to me on the jet? Get my point. Get over yourself. You're going to lose. Everybody loses. There's nothing wrong with it. Losing is just another way to win. And you're like, whoa, what the heck does that mean? You're going to win 50, 60% of the time, and you're going to lose 40 to 50% of the time. You're still going to make money if you do this thing, if you do it properly, right? Okay, so it's not something to take lightly because it's going to have a huge impact on your trading, right? How much are you willing to lose on a trade? And then we already talked about in the beginning, it should be a very small amount of money. But what I ultimately want to talk about is this entry, stop, and target thing, okay? If your entry is $50 and your stop is $49.50, you have a 50-cent stop loss. That means when the stock hits $50, you will enter it. When the stock hits $49.50, you will get out and you will lose money. So if you're risking $500, you would take 1,000 shares in this scenario. You'd buy 1,000 shares at 50, and if the stock went down to $49.50, you'd lose 1,000 or $500. I get it. Most of you are going, yeah, I know that. Then why am I getting so many emails, and why am I getting even comments in the chat room about, yeah, I took that with no stop loss? If it's so simple and it's so easy and it makes so much, here's that common sense word again, why aren't you doing it? Why aren't you doing it? Guys, let me tell you this. And again, I'm non-negotiable on this, and I don't care what anybody else thinks about it. If you're trading without stop losses, you're stupid, and all you are is a ticking time bomb. I don't care if you've been doing it a year or 2 or 3 years. The day will come when the bomb clicks and blows you up. It will happen. Not might happen. It will happen. You'll have a day where you don't take a stop loss and the stock will go down way more than you ever thought it would go down. Ever. And I'm going to show you some examples, all right, in a little bit, like why we take stop losses. In fact, let me skip ahead, okay, real quick. Hold on. Let me find this where we're at. I don't know where it is. Oh, here it is, right here, right here. Here it is. Guys, this is why we take stop losses. Now, just take a look at this, okay? You see this right here? See 73.80? I want you to cover up the green. Just put a piece of paper over that. Cover this up. This is a nice breakdown. There's nothing wrong with this breakdown. It gapped down. It's not an excessive gap. It's consolidating at 73.80. You're going, wow, it's pretty nice. Stop loss is 74 bucks. It's 20 cents. You're going, that's nice. I agree. That's a breakdown I would take. It drops down about 15 cents. Chops, 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 and you're like, I don't need my stop in. So what about this green bar? It's gonna come back down, and no, there it does. It does. It comes back down to 70. See, I told you. Chops right. It's gonna come back, and then boom, boom. From 74 to 75, let's just call it 75.80. It's a $1.80 move. So your stop loss was 20 cents. You were gonna lose. Let's say you had a $500 risk, like the example. You were gonna lose 500 bucks on this, but no. Your ego said, I don't need a stop loss. I know I'm right. I know this stock is going to go lower. And it ends up going all the way back to 75.80. So you lose $2 on this because your entry is 73.80. $2. So guys, do the math. If you took 2,500 shares, that's a $500 risk, 2,500 shares of this, okay? And you lost $2 on it. You just lost $5,000 on something you should have lost 500. You lost 10 to 1 on your money. And it's not even done yet, right? Could gap up the next day. Now what happens? What happens here is this. There's two things that happen. One, you go from being a trader to an investor, and the goal here was never to be an investor on this trade. The goal was always to trade it. Trade it on the 5-minute chart, whatever time frame this is, 2-minute chart. And now all of a sudden you own it. You invested in this stock and you're $2 out of the money with huge shares that if you hold overnight, do you want a $75 stock gapping against you $2, $3, $4? I don't. There's another 10 grand, right? Now all of a sudden what should have lost $500 is now losing $10,000, $15,000. Because of your ego and stupidity, okay? So now you're drinking the hopium. So now what? You know this is true, what I'm saying. Now what? Okay? Now, instead of shorting this stock and taking your stop loss and being done with it, you're reading news reports. You're reading earnings reports. You're checking Google for the latest news on this stock. Oh man, are they going to do earnings? Maybe I'll get lucky and it'll gap down. Oh, they just came out with this positive phase 3 trial on drug, blah, blah, blah. Oh, they just fired the CEO. Guys, it was just a 30, 40 cent scalp trade. You're supposed to be in and out of this thing in like 20 minutes, but now you own it. You own it long term because you don't have a choice anymore. And now your life has become hell because every day you're checking. And it's going further and further against you. And then, to make it even worse for many of you, what do you think you're doing? You're doing the cardinal rule in trading. As if this isn't bad enough, what have you just done? You just cost averaged it to a losing position. You're like, well, I own it at 73.80. If I buy another couple thousand up here, I'll own it at like 74.80. And I'll be really close and I'll get my money back. And then it keeps going against you. And now instead of 2,500 shares, you own 5,000. Ask me how I know all that and how I can spew it all out. Because I've done it. Stupid. Stupid. Thankfully, never to that level of 5, 10, 15 grand. But stupid. That's just crazy. Okay? And yet, right now, as I'm giving this lecture, there is a trader out there somewhere doing exactly what I'm talking about. Right this very moment. And then they become an investor and they start drinking the hopium. You never want to hope a stock goes in your direction. So we go back, right? I want to show you one more thing, guys, okay? I took this right from StockTwits. I don't know who this person is. I blanked out their name, blurred out their name, whatever you want to call it. Now, I'm just assuming it's real. I don't know this person, but it came up on my feed on StockTwits. Let's go through this real quick. December 21st, 12:43, 12:39. We start at the bottom. Let's start at the beginning of the day. 9:29, right before the market opens. FTFT, it's not updating correctly. Hopefully it will cross 450 again. All right, whatever. FTFT, guys, we're 2 hours later now. 2 hours later. FTFT, I'm doomed. I need this to be above 380. 9 minutes later. FTFT, I'm going to have a heart attack. Okay? 31 minutes later. FTFT, I'm down 2,000. I'm 2,000 down. I don't know what to do. Hold or cut my losses. Are you shitting me? Walk away, brother. Walk away, sister. FTFT, 18 minutes later, I'm down $4,000 in an hour. Okay? 4 minutes later, I'm down 4,000 in an hour. Okay? I'm assuming this is right. I blanked out this person's name because I don't want them coming after me for their stupidity. This isn't trading. This is gambling. This is flat stupid. Now you want to know why I am so hardcore on money management. That is telling everything right here. 12:21 p.m. I'm down 2,000. I don't know what to do. Hold or cut my losses. One, it tells me two things. This person is already way past their stop loss. Way past it. Okay? And it also tells me this person wasn't prepared before they got into this trade. This person is not an emotionally disciplined or a stable person. How could you let yourself do this? How could you get to this point? Ego. Pure ego. Because, quote, you knew you were right. There's no way the stock could have ever gone down more than my stop loss. I need it to be above 380. Okay. And if it doesn't, what are you going to do? You're going to walk away. Entry, stop, target. Entry, stop, target. Entry, stop, target. You just get out. But nope. Took 17 minutes, 18 minutes for you to go from 2,000 down to 4,000 down. And who the heck knows? Maybe 18 minutes you'll let down 8,000 down. I don't know. This isn't trading, guys. You want to know why trading has such a terrible reputation online and everywhere else in the world? Because of, excuse my language, dumbasses like this. Because of stupid people like this. This is why people blow up accounts. This is why you hear people, 80% of traders fail or whatever the number is. Because people see this stuff. Well, this is just somebody who should have never been in this business to begin with because you just don't have the mental discipline and fortitude. Because, guys, this is not what this slide is intended for. This is not what the next slide is intended for. But this stuff really does happen. Right? $20 down to $9. Guys, this is a real stock with 1 million shares. You buy the 3-bar play. Swing trade. Looks good. $16. This is the stop loss. This is the entry. Great. There's nothing wrong with that. There's nothing wrong with this over here. Swing core entry at like $16.50. Your stop's at like $15.50. Great. Got a dollar stop. Boom. Goes up, pulls back, goes up. Your stop loss is under the bottoming tail. Why? Because that's the pivot support area. You started with your stop loss down here at $15.50. That's where you started. Fine. Once you got in the money, you raised your stop loss. Why would you be in it down here? Greed, stupidity, ego. But more importantly, what if it never actually went higher? What if it just put in this little green bar right here and then tanked? You're still out at $15.50. Maybe you take a little slippage. Why would you ride this to hell? You want to blow up your account? Is that the goal? I don't know. Maybe. Say you had a dollar stop on this and it tanks. You're down $5 or $6 on it. You just lost 6 times more money than you're supposed to lose because of stupidity. Why did I put this in here? Because it really does happen. This is a real chart. This isn't some made up chart. It really happens. This last chart I showed you, this isn't a made up chart. This really happens. And I think you would all agree.
They were both viable and valid entry patterns. There is nothing wrong with this breakdown at 7380. It's not some hocus pocus pattern we pulled out of thin air. I didn't invent technical analysis. And then this happens. This 3-bar play, it's my favorite pattern in the world. You guys know this. And then this happens. But hey, it's never going to happen to you. Right? We talked about that yesterday. I'm never going to get cancer. That only happens to Alex Trebek. That only happens to other people. No, your number gets called too. Everybody's number gets called. It's just a matter of when it gets called. Do you get called at 99 years old or do you get called at 19 years old? Your number's going to get called. In trading, does this red bar happen on your 8th trade of your trading career or your 800th trade of your trading career, your 8,000th trade? It's gonna happen to you. It's going to happen to you. Take your stop, move on, and it's no big deal. Take your stop and move on, it's no big deal. Okay? It's like the death analogy. For those of you that are very religious out there, if you're a good person, you're a mensch, you do the right thing, it doesn't matter when your number's called 25, 75, 105. You feel like you're going to the right place. If you're an asshole your whole life, maybe you're going to a little bit of a warmer place. It's going to happen. In trading, it's going to happen. Or this is going to happen. One of two things is going to happen because that stock will do that to you. Unequivocally, you will get a stock that just is crazy, totally against what you thought it would do. Take your stop, move on, or don't take your stop and blow up your account or lose a lot more than you should have lost. What I should have put in here is that percentage recovery chart. Because once you lose 40, 50% of your account, it's a heck of a lot harder to get it back. Right? It's a heck of a lot harder to get it back. Okay, so go back to this slide. Entry, stop, target. Take your stops, guys. Take your stops. 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 And also when you're new, just risk 10, 20, 30 bucks a trade. Get over yourself. I don't care if you're the CEO of Goldman Sachs. If you're new to trading, you're new to trading. There's no shame in that. There's nothing wrong with that. We're human beings. It doesn't matter if you're Einstein or Michael Jordan. Einstein's not Michael Jordan, and Michael Jordan's not Einstein. So what does that mean? Well, if Michael Jordan tries to solve a math problem, he probably doesn't know what the heck he's doing. And if Einstein tries to play basketball, he probably doesn't know what he's doing. There is no shame in that. When you're a new trader, you're a new trader. I don't care if you graduated Johns Hopkins, summa cum laude, and you're a brain surgeon who makes $1 million, $2 million a year. So what? This is different. The stock market is different. It's different. 10, 20 bucks. I think I made my point. Now, let's talk about spreads as it relates to trading, money management. Okay? So, this is an example, all right, of a 3-bar play. Wide bar, narrow bar drop. It's quite a nice 3-bar play, to be honest with you. Okay? At 177.50. So you look at the chart and you go, hey, that's pretty nice. I like it. It is nice. Little pseudo breakdown on the 1 minute, 3-bar play on the 2 minute. There's no shares here. You had to take this thing at like 51, 52, 53. Maybe you got lucky and got filled at 177.50. Maybe, right? Maybe. Okay? But under that area, didn't fill anything. Then 300, then nothing, then 300, then nothing. Now, so what's the point, Jared? I'm not here to tell you how to get filled on trades. I'm here to tell you how to be smart on trades. So yesterday, okay, we talked about somebody who either uses market orders to enter trades or gives them way too big of a stop limit order. Okay? Guys, you do realize that if you enter a trade using a market order, in this case, a stop market order, you're at the mercy of the market when you get filled. What does that mean? It means you haven't given the market any guidelines. The only guidelines you have given to the market is just fill me. In parentheses, at any price. Just fill me, quote, at any price. See, if you use a stop limit order, you're telling the market, I want to be filled between 177.51 and say 177.35, right? You're giving the market directions, saying you're giving the market maker directions, 177.51 to 177.35. If you cannot fill me in that range, I don't want to be filled. I'll repeat this. If you cannot fill me between 177.51 and 177.35, I don't want to be filled. If you use a stop market order, you're telling the market maker, I don't care where you fill me, I want to get filled. But I don't care where. If you use the stop market, let's say you took, this was about what, a $1 stop maybe, 178.50, something like that, 50 cents to $1. Let's say you took 500, and let's call it 1,000. Let's say you took 1,000 shares of this. Where'd you get filled? I mean, there's only 900 total shares in a 32-cent range, right? In a 32-cent, from the top here at 50 all the way down here at 18, there's only 900 total shares. Now, I think you're not egotistical enough to think you're the only person in the world who wanted to short Baidu, right? Just you all by yourself? You're the only? No, of course not. There's probably thousands of people that wanted to short Baidu, but only 900 shares printed. So if you used a market order with 1,000 shares, where do you think you got filled? Heck if I know. Guys, in 1 minute, see the 1 minute chart? This stock was at 176.14. The entry is 177.50, and in 1 minute, it was down $1.35. In 1 minute, $1.35. If you used a market order, stop market order, you could have easily been filled $1 late on this, 50 cents late on this. Let's do the mental math. Let's say your stop loss is 188.50 and your entry is 177.50, 1,000 shares. You're risking $1,000. And you get filled at 176.70. You took 80 cents slippage. What's your risk now? Well, your stop loss is still the same, 178.50. But instead of getting filled at 177.50, you got filled at 176.70, 80 cents late. So now you're risking $1,800. 80% more than you intended on risking. What's another problem? Your stop loss is far away. You're going to lose $1,800. But now your target is really far away because you got filled 80 cents late. Can you guys understand why it's so important to use stop limit orders on entry now? Because you get to determine how much you're willing to pay. If you use a market order, you don't get to determine how much you're willing to pay. The market lets you know where it wants to fill you. And in this particular example, the fill would have been really, really, really bad. Really bad. You probably would have double your intended risk. And you're filled 80 cents late, so your target's much further away. Guys, these are topics nobody else talks about. Oh, just buy it over here and blah, blah, blah. Look, I turned $500 into $10 million in 10 seconds. No, you didn't. Oh, it was a dark pool. No, you didn't. Right? So use stop limit orders on entry. And you're going, what does that have to do with money management? It has everything to do with money management. Everything. Because now I get to decide how much I'm willing to pay. I'm willing to pay 15 cents. I'm willing to pay 15 cents. I'm not willing to pay 80 cents. In this example, realistically, guys, if I had $1 stop, I'd be willing to pay 20 to 25 cents on this. That's it. 20 to 25 cents. And I still would not have gotten filled. I would have gotten skipped. There's no question about it. Unless I started my order at 52 or 53. If you started your order at 49 or 50, say 49, and went down to 25, there's no way you got filled. And you know what? Oh well, shit happens. That's just the way trading is sometimes. Sometimes you get skipped, and that's part of the business. But it comes back to money management. I would rather get skipped than get filled at 176.80. And some of you out there, 176.70, some of you are going, why, Jared? It went to 176. Because it's double my risk. See, this is where I differ from most traders. You're looking at it and going, well, you still could have made $700 off it. You're looking at it the wrong way. Why? Because this is the example that kept going lower. You're not looking at the example that leaves a bottoming tail and shoots right back up to 178. So I would rather just say, you know what? I'm good. I'm willing to give it 15, 20 cents. If it skips me, so be it. It skips me. Money management says I don't want to pay more than that. I'm willing to pay, 10, 15, maybe 20% premium on this. Like you want a car so bad you pay 10% over MSRP. But I'm not going to pay 80% over MSRP. That's stupid. And there's only one or two cars in the world that are even worth doing that for. There's only one or two trades or stocks in the world that are worth paying up 80% for. You have to draw the line. And then God forbid you do it without a stop loss. Now you see the conundrum, the trouble you get yourself into. Here's another example. Okay? Beautiful consolidation. A little bit thin, but beautiful. Look at the 1 minute, look at the 2 minute, look at the 5 minute, look at the 15 minute. My goodness, what a nice breakout this is at 150. Just freaking beautiful. 35-cent stop. If you didn't take it at 149.99, 149.98, 150.00, if you didn't take it in that 3-cent range, you did not get it. You didn't get it. You want to risk 500, $1,000? You need 2,000, 3,000 shares. Where are they at? They're not there. What if you used a market order? What if you used a market order? You probably got filled at 150.40. Why? I can see up to about 30. There's no shares there. Remember, you're going to need like 2,000 or 3,000 shares of this thing. You probably got filled like 40, 50 cents late. Guess what? Now your risk is more than double. Your risk has more than doubled. From a 35-cent stop to now, you got filled 40 cents late. Now you have a 75-cent stop. And some of you out there foolishly are going, but it went to 151. You still would have made 50 cents on it. They don't all do this. They don't all do this. Some of them pop, leave a massive topping tail, and then sell off. And then what? You've lost 3-1 on your money. 2-1 because you got filled late and then slippage. So I give it the room I want. I say, you know what? It's a 35-cent stop. I'm willing to give us about 7, 8 cents. Now, how to get filled on this is a different discussion. Different discussion. I would have gotten filled on this because I'd be in at 98 or 99, right? I would have gotten filled because I'd be in at 98 or 99. But that's a totally different discussion. Totally different discussion. Using a market order at 150.01, insanity. Just insane. Now, I'm going to switch gears. So we just talked about using stop market orders as entry and how terrible that is, especially on breakouts and 3-bar plays. How horrible that is. You're not going to do that, right? Now let's switch and let's talk about stop losses and spreads. All right, let's change gears a little bit. Okay, here's another quick example, guys. $26, you're not getting filled. Okay, you're not getting filled over 26. You got to get it at 99 or 00, and you're still not getting filled. Okay, so I want to take an example from today. Sabir, you know it's coming, brother. All right, so we have a trade here on PYX. This actually happened today. All right, this is on our gap list today, and this was actually a decent entry at either $29 or $29.25. You could have bought the pullback. Personally, I think the best thing to do here, right, the smartest thing to do here would have been take a partial lot at 29 and then get full at $29.25. Okay? That would have been the smartest thing to do. All right? But and this is a part that I think a lot of newer traders, even some experienced traders, overlook. I understand, guys. I'm well versed in technicals. I understand that sometimes a stock will give you a chart stop, a technical stop, a chart stop that is tight, and you're licking your chops, going, "That's wonderful, right?" So you get into 29, and the stop is like what, 28.70?
right? See it right there? You get in at 29, the stop's like right there, right under here. Call it 28.60, right? See it right there? That's the chart stop. I agree with you. That's the chart stop. But what might affect how you share size? Well, take a look to the left. See the big circle? This is a live picture that I took. This is a live picture that I took. Okay? 29.66 by 29.98. Guys, what is that? That is the spread. 29.66 are the buyers. 29.98 are the sellers. Okay, that's a 32-cent spread. 32-cent spread. So if you try to get into this stock with a 30 to 40 cent stop loss, what do you think is going to happen? One, where are you going to get filled? And two, what happens if it doesn't work? You guys see where I'm going with this? Okay? Just seriously for a second. 32-cent spread on a 35-cent stop loss. The spread's as big as your stop loss. What if this triggered you, and what if it went to 29.01, filled you, and immediately turned around? Where are you going to get filled? Remember, let's go back, okay, all the way up here. 50 by 49.50, 50-cent stop, right? Well, what's not in here is the spread. What's not in this diagram is the spread. Let's go back. Okay, let's go back. Money management says you have to account for the spread. You have to account for the spread because not every stock hits and goes straight up. You get filled at 29.02, 03, 01, right? And it immediately turns against you. One, it's an illiquid stock. So let's say you wanted $500 risk on this. Let's just say you're risking $500, 35-cent stop. Okay, you're looking at what? 1,300 shares, 1,250 shares, something like that, give or take, right? Give or take. Okay, if it's a 35-cent stop, you're probably looking at 1,500 shares, right? Roughly. Guys, what if it turns around on you? How many shares do you think you're going to get filled? Look at how many shares it's printing all along here. Look at it. Just take a look at it. 400, 150, 1,400, 4,000, 200, 200, all the way up and down. So your stop loss is sitting at like 28.65. Where are you going to get filled? This spread is going to gobble you up. And you're going to get filled at like 28.30, 28.20. Money management says you can't use a 35-cent stop loss. You have to use a wider stop loss. So what would you do in this situation? So the question is, Jared, how do you mitigate? This is exactly what you do, guys. Let me explain. I agree that the stop is the stop on the chart. I agree with this. So you're going to use 28.60 down here. Okay, maybe 28.50. All right, I'll say 28.50. You're going to use 28.50 as your actual stop. 50 cents, 29, 28.50. But you're going to share size for about 70 cents. You're going to take the spread and cut it in half and share size for half of it. Make sense? So what you're going to do is you're still going to get in at 29. And instead of using 28.60 as your stop, you're going to use 28.50. Give it a little extra room. But you're not going to share size for 50 cents. So if you're risking $500, you're not going to take 1,000 shares here. You're going to share size for about 70 cents. Why? Why are we share sizing for 70 cents? For slippage. You will get slippage on this. Not probably, not maybe, 100%, 99.9% chance you get slippage if it stops out. So what are you going to do? You're going to share size for slippage. Now, some people are going, but Jared, that's a 70-cent stop. That means like I need like $1.50 on a $30 stock. Yep. Reevaluate. Do you still want to take the trade? Guys, get FOMO out of your head. All right? Get FOMO out of your head. For those of you who don't know what that means, it means fear of missing out. Guys, PYX is just one trade on one day, in 1 week, in 1 month, in 1 year of your trading career.
It's nothing. You're going to take 1,000 trades this year. This is one. It's not even 1%. It's 1/10%. So what? If it doesn't give you the risk to reward that you think you need, just don't take it because the spread's too big. Right? So what you're going to do is you're still going to get into 29. You're going to use 28.50 as your stop, and you're going to share size for 28.30, 70 cents. Okay, and as the stock moves up, you're going to probably move that stop loss up. So if it stops you out at 28.50, 28.51, and gives you 10, 20 cent slippage, guess what? You lose 1 R. Magic, isn't it? That's the goal, is to never lose more than 1 R. But if you go in there at 28.60, full boat, ripping, full bore, 40 cent stop, 1,300 shares, and it doesn't work, and you take 20 or 30 cent slippage on it, you didn't lose 500, you lost 800 or 900. Stupid. Stupid. I don't care, guys. Okay? I don't care if this thing rips and you go, see ya, I gave up money, Jared. A 40 cent stop, I could have made 3 to 1, but now a 70 cent stop, I can only make 2. I don't care. It's all about protection first. This business is about protect your ass first. Then deal with making money second. Protect first, money second. Protect first, money second. Okay? Somebody's asking me, how do you arrive at 20 cents? I'll repeat what I said. I said, take half the spread and add that to your trade. Take half the spread and add that to your trade. The spread's 50 cents, add 25 cents to your share size. The spread's $1, take 50 cents, add that to your share size. Okay, if the spread's 10 cents, add a nickel. If you want to be really conservative, add the whole spread. Right? Add the whole spread, add 30 cents. If the spread's 30 cents, add 30 cents to your share size. If you were going to use a 50 cent stop, use an 80 cent stop. If you want to be conservative, I think you can use 75. Take half the spread. Right? Take half the spread. All right? So, guys, spreads will absolutely keep me out of trades. You know, we talk about Melly today. Melly had a wicked spread. The stock went like $10. So what? Guys, there are plenty of times where you will look at a stock and you will go, I'm pretty sure this is going to go higher, but I can't take it because it's too thin and too spready. That's the way it goes in this business. If you want to take like 100 shares just to nibble some, maybe. But you're not going to go full boat on a stock that has a $1.50 spread and like a couple 100,000 shares printed in the first 5 minutes of the day. No, unless you're trading Amazon with a $10 stop loss, that's different. That's different. So when it comes to money management, you have to watch out for the order type that you enter with. You're not going to enter with stop market orders. You're going to enter with stop limit orders. You have to be careful about the spread of the stock. You're not going to take PYX with a 30 or 40 cent stop loss when it has a 30 cent spread. And on top of it, you're going to get filled late on the entry anyway. Money management's your number one job. You're going to get tired of hearing me say it. Money management is your number one job. Making money is your number two job. But you know what's weird? Imagine this. They go hand in hand. With proper money management, you'll make more money than you'll lose because you're always protecting your ankles. You're always mitigating against the worst case scenario. You might give up a little bit of money in profits here and there because your stop loss is a little bit wider than it would have been. But you know where you make it back? When they stop out. Somebody else is losing 2 to 1 on this trade and you just lost 1 to 1 or less. So you give up a little on the profit side. Not much, just a little. But you make it back when somebody else gets nasty slippage. Or, God forbid, they enter PYX. I want you to imagine this. I want you to think about what I'm about to say here. You enter PYX using a market order. You get filled 20 cents late. And then you take 30 cent slippage and your stop loss was 40 cents. So do the math. Let's do it together. 40 cent stop loss. Okay. 1,250 shares, $500 risk. All right. Oh, I got filled 20 cents late. All right. Well, now I have a 60 cent stop loss. on 1,250 shares. So 1,250 shares, let's do the math, times 0.6. Now you're at 750 risk. And then it comes down and stops you out for another 30-cent slippage. So now instead of 60, I have 90 cents times 1,260. 0.9 times 1,250. Oh, $1,125 loss on what was supposed to be a $500 trade. You lost 2.2 to 1. That's crazy. That's just downright stupid. It's foolish. Guys, it's just one trade. Get over yourself. It's just one trade. I don't care if this thing goes up $10. It's still just one trade. All right? We're in the business of hitting singles and doubles and sometimes triples. We're not in the business of hitting grand slams. And if you do, you hit a grand slam because the thing just keeps on going, not because it gaps up and you get lucky. You hit those grand slams because you were smart with your money management. Okay? Smart with your money management. All right, so I'm going to kind of wrap this up, guys. I was going to get into some of this other this risk management and things of this nature, but I'll be here another hour if I do that, guys. Guys, just be smart with your account. Okay, set daily, weekly, and monthly loss limits, and set daily, weekly, and monthly targets as well. So, for example, I'll give you just a quick example. If you go, say, minus 3R, you're done for the day. If you lose 3 full stops, like so say your risk is $500. If you lose $1,500 in one day, you're done. Call it a day, move on. Don't go tilt. Flip side. Let's just say hypothetically your goal is $10,000 this month. Okay? Once you get to your goal, say 80% of your goal, say 8,000. Put an account stop in, meaning you won't go under 5,000 for the account. For that month, just for that month, you won't go under 5,000. Once you get to your goal, 10,000, you have 2 choices. You can either quit for the month, say, all right, I'm done. I hit my goal for the month. Or you can say, I'm going to protect 80%. I'm going to trail up 80%. So say you hit your 10,000 goal, you're going to protect 8,000, right? You get to 12,000, you're going to protect 10,000. You get to 15,000, you're going to protect 12 or 13,000. Like you would trail a stock up, trail your account up for that month. Or you can just quit at your target and walk away and take a vacation for the rest of the month. Okay? Be smart with risk management. Money management is so important, guys. I just do not want to see any more of this bullshit. I don't want to see traders taking, I just saw somebody yesterday take a trade that they didn't have a stop loss. It was extremely spready. And they're like, well, I thought it was going to go higher. It's probably going to go higher. Well, what if it didn't? What if it didn't? I don't know. I guess I'd be in trouble. That's pretty much what the response was. I guess I'd be in trouble. That's not good enough. Know what you're doing. Entry, stop, target every trade. Okay? Entry, stop, target every trade, bar none, no questions asked. And I'm going to repeat it one more time because I know you guys love to hear it. Really small risk for new traders. And when I mean new, I mean people not making money. Don't confuse new for somebody who's trading 3 months. I don't care if you're trading 5 years. If you're not making money, you're risking 10, 20 bucks. Period. End of discussion, man. Make money first. Make money first. Then you can increase your risk. I know most of you aren't going to pay attention to that. And you know what? That's good for me. I'm going to make money off you. And everybody else that's a good trader is going to make money off of your stupidity. Be stupid. The market loves stupid people. Be stupid. Be an 80%er. You want to be one of those people who cries on CNN, oh, the rich people have everything. They have everything for a reason. They're smart. Good traders make a lot of money because they're smart, not because they're stupid. Don't be stupid. That's what I should have entitled this lecture. Don't be stupid. Okay? Don't be stupid. All right? So, you earn the right to raise your risk. Respect spreads. Don't use market orders to enter. Use stop limit orders. And be smart with your account. Account protection is your number 1 job. Making money is your number 2 job. All right? I'll see you guys again next week. Hope you enjoyed the lecture.
To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.